Hey guys, welcome back to the Passive Money Podcast. Kirby and Alex here, and on this video, we're going to be talking about dollar cost averaging on the stock market and why it's important. So, Kirby, do you have a specific stock you want to bring up, or you just want to talk about it in general?
In general, dollar cost averaging is very important. Like we talked about in the previous video about has the stock market bottomed. It really doesn't matter if the stock market bottomed or not. One thing I want to point out is we had that government number come out that said inflation came in at 8.5%. 8.5% is lower than what we had the previous month. And then we saw, we proceeded to see like a two week rally based off that because we had one number lower than the next. But in the real scheme of things, 8.5% inflation is a lot. 8.5 is still a lot. So if the month prior was 7.5 and it was 8.5, the market wouldn't be rallying. But everybody's, people's jumping in to say, oh, inflation hit its height and then now we're on the downside. We won't know if we are trending downward until a trend starts. We just had 1 month where inflation was lower. Of course, gas prices are lower. That's a good thing. Rents are still increasing at a 20, 30, 40% clip year over year. So people are still feeling it in their wallet. The job hiring is not as high as it was before. So, and again, 8.5% inflation is still higher than what people get raised on income or on their jobs on a year over year basis. So I don't understand what the hype and the hoopla is about, but if the market want to rally, great. If it don't, great. And the reason why I say great is because of what you're talking about, dollar cost averaging. It don't matter. We can talk about the S&P 500 as a whole, so we don't narrow down the stock and people thinking that we endorsing that stock. But I believe dollar cost averaging is the way to go for 99% of investors out there.
Yeah, I see a lot of people that aren't so invested with the stock market, but they kind of just want to get in and they'll buy a stock, and then when it drops, they just like they're done. The money they initiated with, that's all they're putting in, and they're really missing out on being able to take advantage of the fact that the stock is going down. Because if you believe in that company or mutual fund, index fund, whatever, you want to reduce the amount you have invested in. You do that simply by, if you buy it at say $30 a share and then you buy it at $20 a share again, if my math is correct, you're going to be around 25 or something like that. So you want to drop that price as much as you can and take advantage of it so that you're still buying the same quantity of shares, but the dollar amount you're investing is less and giving you the same return in your position, so that when the stock does continue to grow, you'll see more results from that growth.
Yeah, and if you don't mind, I'm gonna share my screen right now just to give another example of it just right now. All right, let me know when you can see the screen. Can you see it?
Yeah.
All right, so this right here, this is Ford. Everybody knows Ford, and I just picked this one randomly, even though it's a stock that I dabble in every now and then. But this right here is a perfect example, and we talked about it in the class this last week. Let's just talk about two buys, not dollar cost averaging, meaning that you're setting. Let's say we just use Ford. Let's say dollar cost averaging is you want to put in $100 every month, no matter where the price is. That's dollar cost averaging. Your average price will level out. But let's just talk about in this dollar cost averaging matrix. Let's just use this. So let's just say your first buy on Ford was you bought 100 shares at $20 a share, right? $20 a share times 100 is $2,000, right?
Right.
And then so you put $2,000 there. So let's say now Ford drops, and like you said, people buy it. Can you see the screen?
Yeah.
Yeah. Okay. So, and let's say, like you say, the stock drops and then nobody want to do anything with it because they're scared. They're scared that their money is going to go to zero. But if they did the research and they, listen to conference calls, they, follow the company's earnings and things like that and follow the company, and they're still in the stock, So if you put $2,000 here, and if that's all the money you got, I don't know why you blowing your whole load there, but let's just say you put $2,000 here, but now imagine you get it back down here at $11 a share and you put another 2,000 in. So now you put another $2,000 in, divided by, let's say 1130. And then, so that's 176 shares. So combined, you got 276 shares of Ford at $4,000. 276 shares at Ford at $2,000, right?
Right.
So that's 4,000 divided by 276.
Mhm.
So now your cost basis, you bought your first ones at $20 a share. You bought your other ones at $11.29. So your cost basis now with 276 shares using using $4,000, your cost basis now is at $14.50. So right now, with just doing the second buy down here at 1130, and then doing your first buy here, your cost basis, your average cost basis is at $14.50. So you're somewhere in this realm here. You're somewhere in this realm right here. So the stock price is over that right now. So if you just bought the shares at $20 a share, you're still losing. But if you double down and bought another block of shares right here for another 2,000 at 1150, your cost base is at 14.50, and then now you're already sitting at a profit, and the stock didn't get back up there.
Yep.
So now just imagine if you was doing that every month or every 2 months like that, your cost basis come lower and your profit is higher because now the stock is above. And then that's how dollar cost averaging works. I just use 2,000 in this example, but if you did 100 here, 100 there, and then you also have the dividends that is paying also, that's giving you a more cost basis off of shares that they're paying your dividend on just for owning the shares. That's how it works in the long game of doing stock investing. All right, done sharing.
Exactly. I don't have much to add on that, but it's absolutely right. One of the stocks you can also dollar cost average with, I would say, with selling options as well, but that's a whole different realm of the stock market. Did you dollar cost average with Ford, or did you buy like right before it shot up?
Well, my method is anything under $14 on Ford is game time, So I dollar cost average on that also. It's either between my account or my wife's account. My wife was buying it this week when it was lower, or the previous week, not this week, previous week when it was lower, and we just keep going at it. And I mean, they raised the dividend 50%, and we're still building positions out like that, but dollar cost averaging. But we do the same thing in 401k and Roth IRAs, everything we dollar cost average, because it's all going to smooth out in the end. And then the price, like we always say, the price in the future will be higher than it is today. So the profit will be way higher than it is now, especially when we're looking at our golden years and things like that. So dollar cost averaging is the way to go, instead of just grabbing a chunk of money like, all I got is $2,000. Let me just go put it in there. If you got $2,000, do $100 a month. Do $100 a month and dollar cost average in there. The market is not going to run up from you. I mean, as you've seen from the chart of Ford, I mean, we got other charts that we've shown also. It don't go up in a straight line. It don't go down in a straight line. It goes in this kind of fashion. There we go. It's doing this kind of movement here. So you're going to catch some high points. You're going to catch some low points. You're going to catch some mid points, but it's going to average out that your cost basis is going to get lower, and then the price is going to be way higher, and then you win in the end. But that's how you win in the stock market, not just, oh, I got $2,000 here, I'll go, or time the market like we talked about in the previous video.
Right. I mean, like during COVID, what was it? The S&P dropped, was it 37%? Something
Yeah,
like
somewhere
that.
around there.
Yeah, and then
Yep.
it took was it about a year or less for it to return 100%? I mean, so when the stock, and so that's another thing to consider, like back in 2008, the stock market dropped 51%, but then it returned back to its same level. And by the time it returns back to the same level, it's 100% gain. So if you're buying at those lows with your 401k or retirement accounts, continuing to contribute, not buying into the fear, or said that kind of backwards, but buying into the fear, but not, having fear of the market. You can take advantage of getting those gains as the upturn uh, trends.
Yeah, and you said it perfectly. That's exactly how it goes. You have to be able to navigate it. You can't have any emotion in it. It's just you do the work, you understand the companies, and you put your money to work inside the companies. If you just flying blind and you don't want to do the work on these individual stocks, invest in the S&P 500. That is the best 500 companies in the United States, and it won't go to zero. And over the long term, like Alex said, this grows over 10%. Over the past 100 years, it'll average 10%. Some years it'll be up, some years it'll be down, but it'll average over 10%. Each year is compounded, which will be great for you. And that's the way to win in the market. And just like the previous video when we talked about timing the market, don't time the market, and always dollar cost average. If you dollar cost average, you will be better off in the long term. I promise you. And don't buy into the fear. Alex brought it up. Don't buy into the fear. When everybody else is fearful and you see all those scary headlines in the news, that's when you should be finding all the money you can to put in the market. And then when you hear all that euphoric, everybody saying, oh, the stock market won't go down, that's when you should be looking to trim your position or start putting less money into the market. It's the opposite emotion. That's what works in the stock market. Like if you've seen the past 3 or 4 weeks, the S&P 500 has been up. Everybody's like, oh, it's going to the moon. And everybody was plowing money to it. Now, this past week, it's rolled over and coming back down, and everybody's scared out of their mind. My best days in the market is when it's down, so I can buy great stocks at a cheap price. So take that with you, and hopefully it works out for you like it worked out for me and worked out for Alex. So yeah, have a good one. Comment in the comment section below, like and subscribe to the video, like and subscribe to the video. That's what I was trying to say. And yeah, have a good one. Alex, you got anything else
Nope.
before we end this one?
We'll see you guys in the next video.